All right. Now this next one, this one threw me for a loop. I think this was Jeff Kelly that might have been Jeff Kelly on this one. Here's a new way to cook the books. All right. Let's categorize reserve replacements as income. What? I mean, just think about what a great idea. That means that every dollar that you set aside with each mortgage payment for the reserve replacement, you're going to categorize that as income. Now, let me walk you through this so everybody understands what we're talking about. When you go to a particular lender, most every government-sponsored entity, Fannie and Freddie, you'll have what's called a reserve replacement. It's for CapEx expenditures, because what's happening is the bank doesn't want you spending all your money with your investors or with your wages, your salaries, or your property management fee. They want you to take a certain amount of money every single month and set it aside in a bank account called a reserve in their bank, so that you can use that money for CapEx expenditures on the property. In other words, it's a way for the bank to protect their collateral. Now, usually it works is about, when I first started in this business, it was like $200 per unit per year. Now, if it's a good property, you're seeing $300 per unit per year. That creeps up based upon the quality of the asset. It also creeps up based upon how the property condition report came back from the engineer when they were doing the underwriting for that particular deal. If the engineer comes back and says this property is terrible, you're going to need all this extra money to plow into it, then the underwriter is either going to kill the deal, or he's going to say, okay, we're going to need to set aside $400 per unit per year for replacement reserves. So let's say it's 300. They take that 300, they divide it by 12 times the number of units, and that amount gets added to your mortgage payment every single month. You write a check for the mortgage, goes to the bank, they take their mortgage payment out, they take the reserve replacement out, and they set it aside in a separate bank account that you can't touch unless you have capital expenditures, okay? And so what they do, so now that you all understand how the reserve replacement works, here's what this particular owner was doing. So he was taking that $300 per unit per year divided by 12. Let's say it's $10,000 a month. Instead of taking it from the mortgage payment, sticking in the mortgage payment, sending it to the bank, he would include a line item on his NOI that shows reserve replacement income $10,000. Okay, now let's think about this for a second, because you can't use this money for any operational expenses. So this money becomes locked in the income section of the NOI, thereby increasing the value of the property exponentially by the cap rate. And they think that this is okay. This particular seller thought this was fine. The proper way to account for this line item is when you take it, put it in the mortgage payment and send it to the bank, it sits in the bank's account and it becomes a liability of the bank and an asset of yours. What happens is it appears on, yeah, that's right, David, the assets don't appear on the income expense statement. They appear on the balance sheet. It's a balance sheet line item. It's not an NOI. It's not an income expense line item. So it does not appear. So when this seller is trying to put the reserve replacement income on the income expense, I just kind of sat back and I thought, bravo, how clever of them. Let me see if I think I just answered this whole section here. Without kind of going through it. Let me see. All right, so yeah, it's, as in my question of good income or bad income, it's definitely bad income. And also the problem with it is that it doesn't show up with any corresponding expenses. So that thing is always just gonna make the property look fantastic on paper, but it doesn't work that way. You can't do that. and the NOI will be overinflated, obviously. In a second, it should appear, obviously, on the balance sheet, not on the income expense statement, and also funds can only be used for the CapEx. Now, Jim O'Connor, I'm going to unmute you. Jim, what do you mean by, let me see if I can unmute you. I can't unmute you. Jim, you might not have your volume or your that little microphone down the bottom. There you are. Good. All right, you're there. Okay, so what do you mean? Can you use an escrow account? Well, that's exactly what you are using.
Yeah. What my question is, can you use a third-party escrow account just like you would use for closing?
Heck to the no. That bank wants to hold that money and not. I mean, that's what they do. They're a bank. They're going to hold that money. So you sign on, you give them the right to take that money, and you agree. And that's the thing. If you go and I did a whole lesson on the on Fannie Mae, the mortgage and the notes, and I walked through the whole entire document, showing you exactly how the documents work. And there is a document in there that talks about the reserve replacement and how it works. And folks, I'm telling you. You should get, if you're looking to do a deal with one particular bank, ask to see their note and their security instrument documents. And that is where many of you will find that the fact is that there is a personal guarantee on a non-recourse loan. So that's the thing. Okay, Jim, okay. So that's the thing that you want to understand. All right. So Dave, manager user shows capital. If that capital shows capital expenses on NOI statement. If that is the case, you have to back out those expenses. Yes. Oh, Dave, absolutely. So listen, if you receive the financials on the company and you see a huge number for capital expenditures or repair, if you see a huge number for repairs and maintenance, that number, if it's outrageous, that is probably including capital expenditures. They're not accounting for the property the right way. They need to carve out all those capital expenditures. They go below the line. We want to know what it takes to run that property from an operational standpoint, not from a capital expenditure standpoint. So that's why you've always got to look at those numbers. But remember, here's the thing. If the guy's stupid enough to put the CapEx above the line, he's just going to destroy his NOI and the value of the property. So, but you, nevertheless, I mean, the bank is going to fix it for you. The bank is going to look at it, when they do the underwriting, and they're going to, ask to have those numbers taken out. But you want to make sure that you're buying the right property. So you want to know how much of it is repairs and maintenance and how much of it is actually CapEx. Scott Stamps, how would an owner show on the income expense statement the reimbursement from CapEx for expenses incurred during the year? It would not show up, Scott, on the income expense statement. It would show up below the line as capital expenditures. So there'll be a whole list. And typically, it's like an amendment to the financials that shows a whole list of all the money that they've spent on CapEx over a certain period of time. And typically, when you're looking to buy a property, when the guy says, "Oh, I've spent $1 million in capital expenditures over the last 2 years," okay, let's see the receipts. Where'd you spend it? And you want to know where that money went. All right, let me see. Dave Peters, the reimbursement shows up on the balance sheet as a reduction in the value of the reserve account. Exactly, to cover the reimbursement payment. Right. So it all washes out, but it washes out on the balance sheet, not on the income and expense statement. If you put the reserve replacement income as income on the income and expense statement, you will never have a corresponding expense item within there that will wipe it out. So that's why it just overinflates the value of the property nonstop. All right, good stuff.